Good morning, and thank you very much for that wonderful welcome. And I'm amazed to see so many people here on a Sunday morning. I've never spoken on a Sunday morning before because usually nobody would turn up. I'm obviously particularly delighted that the world's second library of mistakes is here. I'm going to, just before I talk, explain what the library of mistakes is and why it exists and what it's supposed to be for. And it is a business and financial history library. And the obvious question would be, well, why didn't you call it a business and financial history library? And the answer is because probably nobody would turn up. So the name is there. It is partly a marketing name, but it has a serious issue behind it, which is we're all aware that people in finance, business, and investment regularly make mistakes. The cost of those mistakes falls on everybody in this room, and it falls on everybody on this planet. It wouldn't it be nice if we made fewer of them? Well, we'll never make no mistakes, but by studying some of the mistakes of the past, hopefully we can make fewer of them. And in the business of what is allocating a very scarce global resource, which is people's savings, we can allocate those savings better for the benefit of the people who own the savings, but also, hopefully, for the benefit of everybody else. So the library of mistakes exists for a few different reasons. One, I believe that financial history can help us all be better decision makers. And I know many of you will not be studying finance, but for those of you who are, you're making a plan for the future. And we all make plans for the future. Mike Tyson, the famous American boxer, had this to say about planning for the future. And he knows this as a heavyweight boxer. He said, everybody has a plan until they get punched in the mouth. So all your plans, I'm afraid, are going to get punched in the mouth. Now, if you go to the Library of Mistakes, you can read about people in the past who've had to suffer the same problems. And you can realize how they reacted. Did they react well? Did they react badly? Did they make the right things once their plans have been blown off track? And I think one of the advantages of financial history is we can learn from that. The second is a new field, or a relatively new field, called behavioral finance. Not that new anymore, actually. Daniel Kahneman and Amos Tversky got their Nobel Prize for behavioral finance well over 10 years ago. And it's about studying, their Nobel Prize citation is for studying human decision-making under uncertainty. And what they did with that is they transformed, or are transforming, the field of economics. The rational economic man, someone I've never ever met, but someone who's on every syllabus of every business school and every planet. He's as elusive as the Yeti, I think, the rational economic man. But he has ceased to exist, or is disappearing, thanks to the work of Kahneman and Tversky. Now, financial history can help us with this as well, because it is really a study of human decision-making under uncertainty. And Kahneman and Tversky approached it from the view of a psychologist, which has been wonderful and helpful and brought so many new things to what we try to do for a living. But I think we can also approach it from the prospect of a historian and look at, historically, some situations where there was human decision-making under uncertainty, where mistakes were made. And you can read about that in the Library of Mistakes as well. So I think there is something in financial history, and why isn't it taught more regularly? Why isn't it taught across the globe? Well, it's a very simple answer, because it was replaced by something called the efficient markets hypothesis, which is an assertion that all available information is in the price. I think the definition of history is all available information. So the people who believed in the efficient markets hypothesis decided there could be no value in history. And I think that has been one of the biggest mistakes. And we as an investment community and we as a society have paid a very high price for that particular intellectual cul-de-sac. I realize there'll be supporters of the efficient markets hypothesis here. And perhaps we could discuss that later. In terms of this presentation, I want to break it into two parts. There's a sort of educational part, which is about why, well, it's the title of the presentation. Why does the stock market go up and down? It's a very boring title. If I was an American, I would call this How to Make Lots of Money in the Stock Market. that would definitely sell better than a mean reversion of equity valuations. But why the stock market goes up and down obviously is something that you can make money out of. But that's the kind of, if you like, academic bit of it. But from the introductions, it's quite clear you'd also like to hear some speculation about the future, which is the second bit, and is what I also do for a living. So I will try and split this into sort of two 20-minute sections. Usually, by the way, the first bit of this takes 90 minutes. So we'll try and cover some of the key points of why equity valuations mean revert, why the stock market goes up and down, and then we'll get on to some of the challenges facing us in the global financial system. So I start with conclusions. Why do I always start with conclusions? Because most of my people I present to are professional fund managers, and if you don't give them the conclusions first, they get very bored. They're used to, you have to feed fund managers conclusions first, and there might be a few of you in the room, you'll understand this, and then we can get to the important stuff after the conclusions. So you're going to see a phrase there, CAPE. Many of you might know it, many of you won't. In equity valuation for many years we've had the price-earnings ratio, which is the price divided by the earnings per share. The CAPE is slightly different. It's also known as the Shiller PE, and you'll probably know it as that. It's become fairly famous in the last 10 years. And instead of using this year's earnings, we use rolling 10 years earnings. So we take a moving average of the 10 years earnings, and the obvious question is why? Well, we do it for the very best reason that can possibly ever happen in investment. Benjamin Graham said we should do it. And basically, if Benjamin Graham says you should do it, then you should just do it. Now, Benjamin Graham obviously said that in Security Analysis in 1934 in relation to the individual equity. And he said this, he said, it is misleading to value an equity by 1 year's earnings, whether it's this year's or next year's. Because you could be at the top of the business cycle, you could be at the bottom of the business cycle. And he suggested looking at the 10 years historic earnings for corporations in working out what the earnings power of their corporate assets was through both sides of the business cycle. And all Shiller really did was to take that and do it for aggregate data for the whole stock market. And he got a Nobel Prize, so it's quite an achievement. And it's been exceedingly useful. And today or tomorrow we run the course, the Practical History of Financial Markets course in Mumbai. We'll be doing a 6-hour session on the cyclically adjusted PE and why it works, and a thing called the Q ratio and why it works. And I'm not going to have time to go through that in 20 minutes. But let's just say that if we look at these two measures of value, CAPE is obviously measuring 10 years rolling earnings. The Q ratio measures equities relative to the replacement value of their assets, which I would say is right up the street for value fund managers who may be here in the audience. They have been predictive of future returns. Now, if you say that where there's somebody who believes in the efficient markets hypothesis in the room, they usually leave. Because this is all available information, this is entirely backward-looking information, and yet it has forecasted future returns. Now, you would say, well, if it's that easy, why doesn't everybody make money? And the problem with it is it only forecasts very, very long-term future returns. It is useless at forecasting next year's returns, and useless at forecasting the years after. And it's probably only if you have a holding period of 10, 15, and 20 years that this is useful. Now, most, I won't say all, but most investment practitioners simply cannot take that time horizon, which is peculiar because many of their clients actually have that time horizon. Anybody here who's 30 or 35 is not really expecting to be retiring until 65, but the manager who's looking after your portfolio is probably trying to get a very good return by Christmas. So it works, but unfortunately we have an institutional framework which can't benefit from it. And obviously if you have an endowment fund for a university, then it really is something I think of great value for an endowment fund to make long-term asset allocation. So you'll have to take my word for it because I can't run through all the data. It's pretty good at forecasting the future. But I'm going to try and add some value in the shorter term because that's the bit that most people are interested in. And as you'll see when I show you the chart, it moves up and down. But why does it move up and down? I think if we have to pick only one factor, and the thing about a stock market is it is never a one factor, but you have to rank these factors in order of importance. The thing about a stock market is reflecting the whole world at any given point in time. So you can never list all the factors that are influencing the stock market, but we could perhaps rank them in order. Remember the famous quote from Einstein when he said, if I was given a problem, I would spend 55 minutes trying to work out the right question, and then the answer would be easy. Now the problem with the stock market is working out what the right question is. And I think one of the right questions is inflationary expectations. And that's what I'll talk about, how changing inflationary expectations are the most important, far away not the only, but the most important driver of equity valuation. And one of the key things about that in the long term is technology. And we need to talk about technology and the role it plays in changing inflationary expectations. And we're in the middle of one of these massive technological revolutions today, and it's having a huge impact on everything in financial markets. I'll also talk about the impact that deflation has on equities, which is extremely negative, and also historically about why 4% inflation has been important. And then we'll get to some speculation at the end about the future. So here is that famous chart of the cyclically adjusted PE, and this is American data. And you might say, why are we just looking at America? Because that's where we have the longest time horizon. It would be wonderful for me to show you the Indian equity market since 1881. If I had the data, I have that. We could put a price index together. The important thing about this is it's full of the most important data, which is fundamental data. The cyclically adjusted PE obviously has all that earnings data in it all the way back to 1881, which is the top line. And the other line is interest rates, and the first thing you notice about interest rates is we're at a new all-time low. So sometimes when you think that there's nothing new under the sun, something new suddenly arrives. Now to talk about this, I want to talk about the bottoms first and then the tops, because equity valuation is a bit like life. The extremes are quite easy to understand. It's the bit in the middle that's often quite difficult. So if we start by explaining the extremes, then we can perhaps work out why we get a mean reversion from one extreme to the other extreme. Now the extreme that I happen to know most about is the bottoms. And that's because, as you mentioned, I've written the book looking at the bottoms. When I first saw this chart, I thought, well, this is a wonderful chart because now it's very, very easy to get rich. All I have to do is wait until it gets to the bottom, and then you invest your money, and then you sit around and do nothing for 20 years and make lots of money. Obviously, nothing is that easy. The interesting thing about the bottoms, there's quite a big range for the valuations of equities at bottoms. It's from 10 to about 6. Now, for professional managers of money in this room, if you've ever bought an equity at 10 times earnings and watched it fall to 6, well, maybe you're an ex-professional investment manager. It's a painful process for an individual, but it's an even more painful process for a professional. So when I saw the chart, I wanted to add some value around the bottoms and try and understand what happened there and how we could add a bit more value as to why equities started going up again. So what I did is I found the day the stock market bottoms in these 4 periods, and that's 1921, 1932, 1949, and 1982. And what I did is I read all the Wall Street journals 2 months before the bottom and all the Wall Street journals 2 months after. So that's 4 months of Wall Street Journal with each bear models, timed for 16 months of bearish Wall Street journals. And people ask why I'm always bearish. So I'm still trying to recover from 16 months of bearish Wall Street journals. But what did I learn? Why did I do it? And I think it's really important why I did it, because I think there's a whole new sphere opened up for investment research, which is not really being capitalized on yet. Because I would not have been able to do this without the digitalization of newspapers. What I want to do is I want to find the contemporary opinion of investors, not with the benefit of hindsight, not the people who look back and with the benefit of hindsight say, well, it was obvious that this was going to happen, because to the people at the time, in the fog of war, nothing was so obvious. So I want contemporaneous opinion, and I want to see mistakes. Selling equities at the bottom of these 4 occasions were the biggest mistakes that investors have ever made. Probably even bigger than buying them at the top. They weren't stupid people. They were intelligent people. They just made mistakes. And if you want to find mistakes, where do you find them? It's really easy. If you want to find tomorrow's mistakes and the mistakes of the day after, they're on the front page of the Wall Street Journal. That's where mistakes live. Because journalists haven't changed since 1921. What they do is they phone people up and ask them for their opinions. And by definition, that's the consensus view, and the consensus view is regularly wrong. So I went in search of those mistakes. And what you discover is the reason that people want to sell equities is because of deflation. This was something I used to talk about on a purely theoretical basis, because nobody that I knew had ever managed money in deflation post-World War II. And then, of course, one afternoon, Lehman Brothers went bankrupt. And suddenly, it wasn't just something in the pages of the history books. And you can see from that chart what happens when, in 2009, when deflation hit, and just how rapidly the equity valuations fell. But it was the same in 1921, 32, 49, and I'll argue 1982 as well. Why this thing, deflation, what is it, and why is it so bad for equities? Well, I think we should scrap the term deflation and call it falling cash flow. That's what's so bad for equity. It's the falling cash flow associated with falling prices. It doesn't happen very often, but when it does, it threatens the survivability of equity. So we often call equity an asset class, and I don't like to call equity assets. I like to call equity the thin sliver of hope between assets and liabilities. You have your assets and you have your liabilities, and that gap between the two is equity. And what happens if you wake up one morning and the price of the assets is going down and the price of the liabilities isn't? Well, then you don't own the assets. The assets will fall into the hands of the creditors. Now, that's a balance sheet movement, but there's also the P&L movement. Your revenues fall faster than your costs. You don't own that company anymore. The creditors end up owning that company. This is a lesson I should really give to Donald Trump, shouldn't I? About what happens, about what happens when the cash flows of corporations fall and what happens to the equity. Anyway, we should move on swiftly. So that's why equity suffers so badly. And I want to talk, and I'm sure many of you are familiar with basic discounting techniques and net present value calculations. And what happens, and I want to mention specifically General Electric here, because General Electric is a company that's been around for a long time. It's a wonderful, wonderful company. And even in the index, you would have gone into this index by the 1890s. And if you were doing a net present value calculation for General Electric in 2007, you would have plugged in the discount rate, the earnings rate. And there's another thing you put into that calculation, it's N for discounting period. And the discounting period you'd have used would have been infinity. You're aware that, given the joys of discounting, anything more than about 10 to 15 years out doesn't show up in the NPV anyway. But you'd probably have used infinity. Why infinity? Well, General Electric's been around for over 100 years. And that's what you use to calculate its value. And then something happened in 2009. The man who ran General Electric, a man called Jeff Immelt, went to see the President of the United States, and he said this, Mr. President, we can't sell our commercial paper in the market anymore. And if we can't sell our commercial paper in the market and raise short-term cash, there isn't a General Electric. Now, that was one of the reasons why things started moving pretty quickly in March 2009, and things got down. What was the discounting period you put on the net present or the future cash flows of General Electric in March 2009? Was it still infinity, or did it shorten? And I think it probably shortened a lot. And for most of us who were around managing money then, there was a real fear that perhaps the corporation wouldn't be there by Christmas. So that's why deflation is so bad. It's because it actually, I think, shortens the discounting period because you're concerned about the survivability of the company, and it can have a dramatic impact on what you consider its net present value to be. That's why it gets cheap. Why does it turn around? Well, what I discovered in writing this book, which I used in March 2009, fortunately it turned out to be correct, is that you need to find indicators that the deflation is not going to happen, that it's going to turn around, it's going to go up, cash flows are going to stabilize, corporate profits are going to go up, the defaults are not going to occur, and the ownership of those assets is not going to pass to the creditor. And the ones I singled out and we used in 2009 are the copper price, which still, after all these years and the massive transformation in the global economy, still seems to have an effect of going up ahead of a turn in the global economic cycle. The second one was corporate bond spreads. Corporate bonds are also terrified of declines in cash flow. It's a debt. You can lose everything if the cash flow is unable to support the interest expense. So just before, and about 6 weeks before the bottom, on the 4 occasions I look at, but also in 2009, a very wide corporate bond spread, which was pricing in default, began to contract, suggesting things were getting better. And for some reason, throughout history, the bond market has been better at picking that up than the equity market. And the final one is a new financial instrument. It's called Treasury Inflation Protected Securities. So we now have a formal market in inflation. And that also began to back away from some of its extreme deflationary forecasts at the bottom. So that's what the bottoms are. They're this great fear of falling cash flow eradicating the equity. The tops, there are two words always associated with the tops, and the two words are new and economy. And those two words tell you a lot. Now, first of all, there aren't many bottoms and tops on this. That chart doesn't really coincide with the US economic cycle. I think one of the things we like to think is that there's some sort of relationship between the economic cycle and the price of equities. But actually, in terms of the extremes of this, there isn't. They don't come, the tops and bottoms of business cycles come regularly, and these come very infrequently. And they come with the words new economy. And what does the word new and economy mean when you put them together? It means a belief by investors that we found a new way of growing. That there's a new combination which will be incredibly bullish and optimistic for the stock market. And that combination is simple. A belief that the economy can continue to grow very rapidly, but without inflation. That net present value calculation again relates to the discount rate, and the discount rate has to relate to the inflation rate. And there's a new technology. And people make the following statement: this technology means that inflation is never coming back. This technology means that whatever the growth in our economy will be, inflation isn't coming back, and therefore the interest rate isn't going up. And on a permanent basis now, we can use a permanently lower interest rate while retaining a high growth rate. And if you've ever tried that on a net present value calculation, the impact it can have is pretty dramatic. But it has to be a rare thing, because you have to believe it's sustainable. And this has been the key historic mistake. To believe that when technology comes, it creates a sustainable death of inflation. It can create a prolonged death of inflation, but not sustainable. And it is interesting to look at the history since 1881 and look at the massive technological transformation of this US economy over that period, whether it was the railroads, the internal combustion engine, petrochemicals, the computer, the internet. All of these things did promise and did deliver lower prices and high growth, but it wasn't sustainable. And I don't believe it is going to be sustainable today. My own view, and I'll come to this in a minute, is we're going to have some deflation before we have inflation. But that's the peaks and that's the troughs. So what about the midst in the middle? Well, if the real highs are driven by a belief in a low discount rate and a high growth rate, then it's not too difficult to work out why people get it wrong. They either get one of those two variables wrong, or they get both of them wrong. And I think what this chart shows is, if you get the growth rate wrong, if your estimate of the growth for the economy slash corporate profits and corporate earnings is wrong, then equities can fall very, very quickly indeed. We've just witnessed that, obviously, in 2009. We obviously famously witnessed it in 1929. Now, having lived through 2009, did the equity market fall because the discount rate went up? Absolutely not. The discount rate was collapsing. Whether you wanted to take the short end or the long end, the whole yield curve was falling from 2007 into 2009, but the equity market was falling faster. So it had to be the growth bit that we got wrong, and the same was true in 1929. The Federal Reserve was cutting interest rates the day after the stock market crashed in 1929, and the stock market fell 88%, despite a falling discount rate. So we clearly got that growth thing wrong, and every time we've done that, you see a very rapid decline in the stock market. The long-term ones tend to be associated with inflation. The great surprise from 1901 to 1921 was inflation, clearly associated with a completely unforeseen event, a dreadful event called World War I. And that basically, I'm going to argue to you that if you get the discount rate wrong, at least you get it wrong slowly. The rise in the discount rate is never 200, 300, 400, 500 basis points. where the decline in the growth rate can easily be 200, 300, 400, 500 basis points. And interest rate cycles tend to be very long. And also from 1966 down to 1982, that was a problem associated with inflation, dramatic inflation in the 70s, and the discount rate ended at levels that nobody had forecast. But on both occasions it happened much more slowly. Is there anything in this chart on American data that we can say about India and say about emerging markets? I think there are two things. This is American data, but I don't think it just applies to America. I think the bands or the range of the cyclically adjusted PE give us good indications for everybody, for every market in the world. Because what they're saying is at the top, they're pricing in a combination of growth and inflation, which has never been sustainable. Now, it may be that the Indian economy is going to be even better than the US economy. It's possible. But I think it's unlikely, because this economy has had thrown at it since 1881 almost everything you could throw at an economy. It certainly had it was an emerging market in 1881. It was an emerging market that was shunned by international investors. Nobody would touch it. Why wouldn't they touch it? It just fought a civil war, where the value of half of the financial assets went to zero and were destroyed, because half of that market defaulted on all of its debts, i.e. the Confederacy. It was also a pariah because it had constantly defaulted on its debts anyway. When, many of you will know the novel by Charles Dickens called A Christmas Carol, and when Scrooge wakes up after his second visit, one of the nightmares he's had is that his investments had turned into American securities. So that's how much hated this organization was. And you know, the British investors in 1881 had more money in India than they had in America, because they obviously thought India was different. They obviously thought the British had colonized India, and they saw these as quasi-British securities. And they picked the wrong emerging market. You know, the one which country became the economic superpower of the 21st century? It was America, not India. And yet, look, it didn't really make any money, at least initially. In 1901, this is an emerging market. In 1921, it is obvious that we are living in the American century. The First World War has destroyed the established order. And what happens to the stock market? It goes from 25 times earnings to 6 times earnings. So you were going against the trend. You were saying that everybody who was betting on the British Empire was wrong. And this massive chaos that had come out of America in the 19th century, that's where you should be putting your money. And you still watch the value of your equities more than halve. So why? Well, the first thing is really what this lecture is all about. And all I'm really doing here is stating a little phrase from Mr. Buffett, who famously said, price is what you pay and value is what you get. And it doesn't matter if you pick the right economy, if you pay too much for the equities. So the first mistake people made is they got this right, but they just paid too much for it. It didn't matter that it was this great growth and emerging economy if you pay too much for it. And the second thing that they got wrong, which is also a problem for emerging markets, is this index. And when you think of an index today, you think of a fairly broad scope for different types of industries and businesses, but this one is actually nearly all railroads. So you got the right economy, but you bought the index and you got the wrong industry. And it was an industry that suffered from gross overcapacity, and an industry that was ultimately nationalized during World War I to help with the war effort. It was privatized after the war again. So I think there are some lessons in here for investors in emerging markets as well. 25 times earnings is, generally speaking, for the long-run investor. This is for the market as a whole. It does not relate to individual equities. But for the market as a whole, it's probably too much, even if you're looking at an economy which is going to grow pretty strongly. And anything under 10 is probably too cheap. In the course that we're running in Mumbai the next 2 days, we show a scatter diagram looking at growth rates of the economy and returns from equities. And there is no relationship. There's basically no relationship. The biggest mistake that investors make is to believe that there's some relationship between these two. I've been doing this for quite a long time. I went to the first ever listing of a Chinese equity, which I think was in 1993. It was the first time foreigners had the opportunity to buy into the Chinese stock market, and the equity was called China Southern Glass. And as a young fund manager, I watched as the stockbroker put up a chart of the growth rate of India, and we just laughed, or not of India, of China. We just laughed and thought, this is classic stockbroking stuff. There's just no way, there is no way that China is going to grow at 5% a year for the next 20 years. He's just being far too optimistic about the growth rate of China. And we can't buy this company because there's no way that demand is going to be anywhere near as strong as this guy says it is. And of course we were completely wrong, because China far surpassed the growth rate that we had, that we thought was impossible. And what happened to the share price of China Southern Equity? Or China Southern Glass? Almost nothing. It's gone up more recently, but for a couple of decades it really didn't go anywhere. And actually all the demand forecasts were too low. The demand for glass in China, if you've ever been there, has even outstripped India. The amount of, I mean, driving up here, you see the amount of new glass. It's nothing compared to China. And yet he didn't make any money in the equity. How could that be so? Because you forgot to forecast the supply. So that's why there's a certain dynamic in this, and it's the most important thing. If you remember nothing else that I've said today and you go on to be an investment manager, just remember this bit. Try to spend as much time forecasting supply as you do forecasting demand. That's a very simple thing to say, but believe me, there's hardly an investment manager in the world who does it. Because forecasting demand is kind of sexy and interesting, and you get to talk to economists and macro people, and you spend your time having these great big thoughts. And forecasting demand, or forecasting supply in the glass industry, there's not many people who find that interesting, you know, traveling around the world looking at where new glass plants are going in. So if you can do that, there's one book, by the way, you should read on that. It's called Capital Returns. It's a new book, but it's one of the few books I know that actually begin to look at this. So I think we better get on to something to do with speculation fairly quickly. So I'm going to skip a couple of charts and get on to the future. Let's talk about, well, I want to just talk about this first, because this actually is the most important chart about the future. And this is US corporate profits. And this actually is one of the most mean-reverting series in economic history. If you're going to use an indicator to forecast the stock market, you better make sure it mean reverts. Because if it doesn't mean revert, then I feel it doesn't have much predictive purpose. But this one does. And I'm pessimistic on the outlook for the US stock market. I'm pessimistic on the outlook for the world stock markets. And one of the reasons is because of this chart. And it shows that how corporate profits as a percentage of the US economy have reached incredibly high levels. And this is why you need a liberal arts education. You need a liberal arts education to understand this chart if you're going to be an investor. Because this chart isn't really a finance chart at all. Corporate profits as a percentage of GDP has nothing to do with finance. It's got to do with society. In any given society, shares of the wealth of that society accrue to different bits of it. If you're a creditor, you get your interest expense. You're getting some of the wealth of society. If you're a laborer, you get some of the wealth of society. If you own a company, you get some of it as well. And obviously the government gets a bit. And throughout history, the shares of this have gone up and they have gone down. And we're now at an all-time high. And I believe it's highly, highly likely that it will come down. And it's difficult to be bullish and optimistic on equity markets when it's at an all-time high. So sometimes when I do this presentation, particularly in America, Americans are very keen to suggest that this time it's different, that US corporate profits are high, they're going to stay high. And they say, well, you know, you're the financial historian. Give us a scenario in which that happens. Give us a scenario in which the corporation continues to take a lion's share of the wealth of the country. You keep telling us it can't be done and mean reverts. There must be some way it could happen. And I say, well, maybe it'll reintroduce slavery. Because this is a societal thing. Society has to decide that this is what it wants. If society doesn't want it, society doesn't get it. Even within the United States of America, the president has regularly and often attacked business. I tell people that, and they say American presidents never attack business. American presidents are captured by business. But it's not true. Teddy Roosevelt famously attacked the Standard Oil Company. And he attacked many other businesses as well and tried to break up their monopolies and bring down their power. Woodrow Wilson famously did the same. The second Roosevelt did the same. John F. Kennedy did the same with the steel companies. Because if you're a US president and you really want to attack business, there's only one word you have to put in front of it to give you the moral right to go after businessmen, and that's the word big. Big steel, big oil, big pharma, big Amazon, sorry, that was a slip of the tongue. Big Microsoft. As soon as you put the word big in front of it, because Americans are not in favor of business per se, they're in favor of opportunity. And there are certain scenarios where big businesses reduce opportunity. So I think it's highly likely that we'll have another US president who wants to do something about this. In fact, I think in America, if you put the word big in front of charity, they'd probably be against that as well. So there's a rich vein in America of actually attacking business when it gets too powerful and strong, and I think we're about to see that. So who will take market share, if you like, from the corporation? Why will corporate profits fall? I think the taxman will take market share. I think labor will eventually take market share. Even the creditor eventually might take some market share. So everything else I'm about to say is much more speculative than this one. When you make a forecast about the world, you have varying degrees of confidence in your forecast. I have a high degree of confidence that this is going to be reversed, because I can't imagine a society in which it doesn't mean revert. Or maybe I just don't want to imagine a society where it doesn't mean revert. We need to talk about some of the more short-term speculative issues associated with this. So I'm going to try and briefly talk about the current global monetary system we have and why it's breaking down. Now, it doesn't have a name. We used to have a thing called the Bretton Woods Agreement, which collapsed in 1971. We've had all sorts of things going on since then. But effectively, here's the monetary system we have. As emerging markets have got into trouble since about 1995, and as their exchange rates declined, they decided not to let them go back up against the dollar predominantly. So across the world, you have these emerging markets. They're really trying very hard not to let their currency go up against the dollar, and obviously, primus inter pares, number one, a country called China. But I think this monetary system has huge flaws, massive flaws in it. It's not the Bretton Woods Agreement. There's some crucial differences with Bretton Woods, which mean this one is unstable. Number one, everybody got to choose their own exchange rate. Can you imagine this room is full of countries, and we sit down and we have to work out where all our currencies go together? Well, if you're the politician who agrees to an overvalued exchange rate, you won't be a politician for very long. You know, the cost of running your economy with an overvalued exchange rate is a shrinking economy, falling wages, and you're not going to get elected. So the idea that we just let everybody in the emerging markets choose their own exchange rate means that it wasn't done properly. And it means that somebody got a huge advantage, and obviously I'm thinking particularly of China again. But it means that we built up massive imbalances. If your exchange rate is only somewhat competitive, then you'll only run a fairly small external surplus. But if your exchange rate is massively competitive, you'll run huge external surpluses, and you'll run them year after year after year after year. And what those surpluses force you to do is to print more money. So this is a very famous chart. This is the world foreign exchange reserves. And this is what happens when you intervene with an undervalued exchange rate. Your reserves go up, you have to intervene and your reserves go up. But the thing that nobody really ever talks about is the other side of this. This room will be full of accountants, I suspect. There are two sides to everything. That's what accountants like to say. So when these guys get the dollars, they create something over here as well. And what they create is money. So those large surpluses they got were turned into money, and they printed more and more money. And if you print a lot of money, eventually you get a lot of inflation. In fact, you usually get a lot of debt as well. And what's happened in this situation is because the imbalances were so big, particularly for a country like China, it's produced a lot of money, it's produced a lot of debt, and we've got massive, massive imbalances. The next difference with the Bretton Woods Agreement is that we lived then in an era of capital controls. So it really wasn't possible for capital to move across border in any great situation. Now it does, and it gets capitalized. So if you get all the capital of America trying to enter China, actually they transform that into money. Anywhere else, the exchange rate goes up. You bid for the fixed resource that is the exchange rate, that is the money. But in China, they just print it. So if everybody on this side of the room were the wealthiest people in Boston who'd been accumulating money for 300 years, and you all decide to invest into China, then suddenly the accumulated savings of one part of the world turns up in money creation in another part of the world. Now, I think that has got to be the most stupid form of monetary policy we've ever devised. There's a stock of savings being turned into a flow of money. So this is a system which is very, very fragile, and it's produced too much debt. And as that chart shows, it's beginning to reverse. These reserves are beginning to come down. China's reserves are coming down. Its current account surplus is not large, but most importantly, its capital account, the net amount of capital that flows in, is regularly negative. China is actually a net exporter of capital on numerous occasions, and yet has to try and retain its exchange rate while it does so. So, some forecasts about what all this means for the world. I think it does mean a devaluation of the renminbi. For China to reflate properly, which it needs to do because its debt burden is high, it would not be able to do that with a stable exchange rate unless it was running far, far bigger surpluses. I don't see its surplus turning around. I don't see its capital account turning around. Chinese businessmen are removing capital from China for many reasons. Number one, most importantly, they don't want to live in China. 60% of Chinese millionaires want to leave. Ask them why they want to leave. They say, we want clean air, we want the rule of law, we want health care, we want education. And those things will come to China eventually, but they're not coming quickly. And so those people are leaving, and they're leaving with their money. The statistic, the amazing statistic, is 60% of Chinese students who leave China never return. I don't know what the number is for India. I don't know what percentage of the hundreds of thousands of Indians who study offshore never return to India. But I think actually the interesting thing is that number is getting much better over the last 20 years. And many, many more Indians are coming back. Actually in China it's going the other way. If you've created a society where there's massive structural capital outflow and a currency policy, then you've got a ticking time bomb. And that's what China has. So I think we all know in this room what a devaluation of the renminbi means. It's tough for everybody. The Chinese will start cutting the selling price, the dollar selling price of products. But for investors, I think investors would leap to this conclusion. We thought central bankers could give us inflation, and they failed. I think that's the important thing for us as investors. The belief that the Federal Reserve can create money and inflation, I think will go out the window pretty quickly if China devalues. And for those of you watching it on a daily basis, it's falling pretty quickly at the minute, relative to the dollar. The dollar's going up, so I think there'll be a squeeze up on the dollar and the renminbi will adjust. I think I've covered nearly all of those points. I just want to talk a little bit about the mechanism through which the world is in trouble. So this is America's current account deficit. So I've just made this forecast to you that I don't see the emerging market current accounts improving dramatically. I don't see their external accounts improving dramatically. Why don't I see that? It's possible, isn't it? Isn't it possible? Of course it's possible. The reason it's not probable is because of this chart, and it's the US current account deficit as a percentage of GDP. Now, most of the emerging markets peg their currency to the dollar as America ran bigger and bigger and bigger and bigger deficits. Therefore, somebody somewhere is going to be running bigger and bigger and bigger surpluses. So you've got that currency policy, you've got surpluses, it forces you to create lots of money, you get lots of growth, but you get lots of inflation. And then we have a recession, and this does exactly what you'd expect it to do in a recession. It contracts, no surprise. But the next bit is transformational. Since America's recession ended, and it ended in June 2009, the current account deficit has not got bigger as a percentage of GDP. This country is moving into a new way of growing, a different way of growing. It's a way it grows without a bigger current account deficit relative to the size of its economy. And that is actually, once again, one of the least forecastable things that anybody forecast. It was just a belief that when America grew, it consumed. And when America consumed, it consumed stuff. And the stuff it consumed came from somewhere else. And we have to begin to accept that that's all changed. And why has it changed? It's changed because of the aging population. There is this thing, not just in America, but elsewhere, called the baby boom generation. Its age is now 52 to 70. They still consume, but they're consuming services. They're consuming, weekends away. They're consuming increasingly visits to the doctor when they get to 70. But they're not in the same way consuming the stuff that they consumed in the 1991 to 2007 period. And that's why this economy has found a way of growing without blowing out its current account deficit. It also has shale oil and gas in there, which is obviously very important in this as well. But it's another way in which America doesn't run the size of deficit needed to transfer liquidity to everybody who's linked themselves to the dollar. So if I'm wrong in this and this begins to blow out, then the world would be a better place. If America's current account deficit gets bigger and bigger, then it would clearly be, the world would be a better place, particularly for China. But it's been pretty stubborn. And we're not creating inflation. You know, to be pessimistic or to be optimistic in the world, I think we have to believe that central banking is working. Central banking is creating growth, and it's creating inflation. It's taking us away from the fragility I mentioned of the risk of falling cash flows. Now this chart goes out to 2020, it's a forecast by the IMF, but one of the things I like to ask people, if I just showed you the data and asked you when did we have extreme monetary policy? Where did they launch this massive printing of money? And the answer is when inflation was high. Inflation 2009, 2010, 5%, and since it's been active, it's fallen every year. And the IMF forecast could easily be wrong, perhaps it has to fall further. Now, if globally this was all working, if globally central bankers were returning us to a world of growth and inflation, where's the inflation? I think there's significant evidence that it's not working. And just, I'll try and speed up a little bit. Now, this is just some data on the debt of the baby boom generation. And in the very far column, the very first column shows you the age of the household. So if the age of the head of household is less than 35 years, then 84% of those households are going to have some form of debt. And the rest of the data just breaks it down, final column. But look what happens as the generation gets older. The percentage of the household having debt goes up, up, and then suddenly it starts coming down, and then suddenly it comes down dramatically. The 55 to 64-year-old age group, 82% of those households have got debt, and suddenly, by 65 to 74, 66. That's where the baby boom generation are. They're passing through that period, and they're reducing their debt. How do you grow an economy when one of the big chunks of society is reducing its debt? How do you grow bank loans and create money when they're reducing their debt? In other words, with most money being created by commercial banks, not by the government, with most money created through the fractional reserve banking system, their biggest customer is naturally de-gearing. So central bankers want to deliver us inflation, but they can't because of this de-gearing. And this baby boom generation is in many different places. I have a very easy solution to this. I know exactly how we can get people to borrow more money, exactly how we can grow the economy, and exactly how we can produce more growth and more inflation. And we forgive student debt. You can cheer if you want to. But forgiving student debt is the obvious way that we solve this problem. It doesn't matter if you make the baby boom generation, if you give them cheaper and cheaper credit. If they don't retire their debt, they don't retire. They're not going to respond to a lower interest rate. But certainly in America and in many places around the world, the younger generation is burdened with far too much debt and with student debt. And it's stopping them borrowing money to buy homes, it's stopping them borrowing money to buy automobiles. And we should move that over into the government sector and realize that it was a mistake to charge people for an education. Now, if America did that, it has $1.4 trillion of student debt, so quite a phenomenal number, $1.4 trillion of student debt. If you put that in with the government's debt, you could barely see it. Yeah, it's quite a while since I've been down to Times Square, but on a gross basis, I think we're getting close to 18 trillion on a gross basis. The market would barely flinch. What would the students do? We have lots of students here. What would you do if you were suddenly one morning you woke up and you didn't have $1.4 trillion worth of debt? I think you'd borrow $1.4 trillion. Or maybe 700 billion or whatever. But there would be an instant response in consumption. There would be an instant response in bank borrowing, and there would be an instant response in money. And you say, well, why isn't that being done? It's being done for a simple reason. It's not monetary policy. It's a fiscal policy. And the reason the world isn't growing and reflating is that we have political stagnation and political paralysis in most parts of the world. One thinks of Europe and one thinks of America, and that's not going to change after the American election. Whoever their president is highly unlikely to control the Congress, and highly unlikely to take some of these steps. And in Europe, obviously, we have a much bigger problem. We're trying to bring all these nations together, and they are politically diverse with different political opinions. But if the world gets into a difficult place, don't give up, because things will change. But it's going to have to be a fiscal change, and a change brought to us by governments, at least initially, to trigger this growth. So until the governments can do that, I'm really pretty pessimistic about about the ability of central banking to provoke growth and inflation, and therefore I'm fairly nervous about what the stock market has for us. That's just the savings rate. I think the savings rate of America is a demographic function. The first thing that happens to the baby boom generation when they get a job in the late 1960s is they start spending and they start borrowing. And that goes on and gives you a society that looks like it's a society that's entirely based upon borrowing and spending. Because if something goes on for 20 to 30 years, you think it's sustainable. But it actually was only a demographic function. And as they get older, they move into saving. And if the saving rate goes up, America will run a current account surplus. Now that sounds just like a little throwaway line, but it transforms the world if America runs a current account surplus. China, for instance, in particular, is completely and totally isolated if America's savings rate was to continue to rise and this country was to move into a current account surplus. So it's ultimately what you discover in finance. Few things actually can be forecast. But one of the things that we can forecast with a higher degree of possibility of being right is demography. So we need to think a lot about demography and what it means. Once again, it means absolutely nothing for the short-term investor, but it means an awful lot for the long-run investor. And the aging of the baby boom generation, to me, means that we're going to have more chance of deflation than inflation, and particularly that China will devalue. I'm going to go straight to the conclusion. Those conclusions all relate to how the market works, but let me do, because I know you want some views and opinions of what it means for individual asset classes. In the short term, if central banking is going to fail, then I actually think government bonds continue to be a good investment. They, as you know, they benefit from falling inflation and they benefit from deflation. But that's a fairly short-term view of the world, because in the long term, as I've said, the politicians will be back and they will give us inflation, and you will lose money for a generation in bonds. It won't just be for a year or two. Something else they'll bring to us is that this inflation, obviously, if you're in the developed world, that inflation will make government borrowing significantly more expensive. Anyone who's going to lend to the government is going to demand a higher rate of interest if inflation's out there, and I don't think the government will permit that. So I think there'll be lots of controls coming back into the West to try and control the price of credit. In other words, we've already ended the market in money. The market in interest rates is over. What we see, I believe, is a temporary phenomenon, because central banks are intervening, is actually a permanent phenomenon. Because the West has a very simple problem. It is too much debt. And the only democratically acceptable way to get rid of debt is inflation. But inflation by itself doesn't necessarily solve the problem if people keep repricing what they charge you for debt. So you have to stop it. So the bond in the long run will be one of the worst investments for the world. And that's what we need to say a little bit about India, because India doesn't have this problem. It's one of the most exciting things about India, is you don't have the debt problem. It may look like a lot of debt to you, but believe me, compared to what we have in the United States, United Kingdom, Europe, the debt levels here mean that India does not have to pursue any of these policies, which is a really exciting opportunity for India to go in a different direction. That's true for many emerging markets. It's not just India. But it is wonderful that India stands out as having a low government debt to GDP ratio, a low private sector debt to GDP ratio, and a foreign currency debt to GDP ratio, which seems reasonable by historic standards. But the West has to go that way, which is very bad for bonds. It's very bad for equities as well. As I said, they're very overvalued. The more the government gets involved in allocating money and credit and capital, the lower the return on capital in the private sector. I think we can see that very clearly in China today, under Xi Jinping and what he's doing, but it will come to the West as well. In fact, I call the next 20 to 30 years for the West, I think it's best described as capitalism with Chinese characteristics. And as I pointed out with the China Southern Glass analysis, even if your economy is growing, it doesn't necessarily mean you make a great return from corporate capital if you live in this world of greater and greater control. So what do you do with your money during the intervening period? Well, I think cash is still a good investment. Waiting is investment. And I'll just finish on this note. You learn lots of things doing what I do for a living. I meet lots of incredibly intelligent people, and very many intelligent people doing very stupid things as well. But one of the things I do is I go to see hedge fund managers occasionally, and there's a killer question. Everybody has to have the killer question. The problem for the hedge funds is they all have the same killer question. They always say this: all right, tell me what we can do that nobody else is doing. We've got to do something that's different, contrarian, unique. What is that thing? You see, you go out there, Russ, and you talk to all these guys, and they always call me Russ, so they're not very good with the syllables either. What are we going to do that's very different? I said, well, there is one thing I can guarantee to you, and I can absolutely guarantee that this will make your funds perform better. I can guarantee you'll perform better than your competitors. And also, it's really easy to do. And you can see them starting to salivate, thinking, what is this one thing? And they said, well, what is it? What can we do? And I said, well, have you ever thought of trying patience? Now, at that stage, they just look at me kind of, and then they just go, all right, well, apart from patience, what can we do? So the moral for investors is that the short term is perhaps impossible to predict. The medium term is difficult to predict. But I think with some of the benefits of analysis you'll get from going to the library of mistakes, at least you have a reasonable chance of forecasting the long term. Some of you know, because I once wrote a piece called I don't know whether you thought it was a compliment or not, it was called Buy Chaos and Sell Order, recommending that you invest in the chaos of India rather than the seeming order of China. And in the long term, I continue to stick with that forecast, that the order is there to be shattered and wonderful things form out of chaos, and are clearly already forming out of chaos. So on that more optimistic note, I'd like to finish, but do you want me to take some questions? Or?
Yes, I think sure.
So view of the performance of Indian government over the last 2 years.
Sorry, the view of
Performance of Indian government over the last 2 years.
I don't spend any time at all looking at in detail what the Indian government's up to, but like most foreigners, I think this is one of the better governments in terms of what it's doing. So I'm not going to comment on Mr. Modi and any of his exact policies, but life is about generally heading in the right direction. Actually, there's a good quote from Keynes on that. You know that John Maynard Keynes once said it was better to be roughly right than precisely wrong. Well, I think this Prime Minister is roughly right. Some of the other ones were precisely wrong.
Hi, my name is Rahul Rathi, and my question is about evolution of brands, and in the current chaotic environment or the orderly environment in the West, how are brands going to perform in the next 5-10 years?
Sorry, did you say plans?
Brands. So brands like maybe large companies like Amazon or Microsoft or things like that.
So particularly tech companies or any company?
Any company, just as a historian.
No one's ever asked me that question before. And I get asked a lot of questions. I think there's a real shock coming for these companies. Now, I do speak to some of these companies, and a businessman should be a pragmatist. And yet I meet a lot who are not pragmatists. They're actually ideologues. And you don't have to agree with the ideology or disagree with the ideology. You just have to say that when you meet someone who's an ideologue, then they've probably got a problem. So over and over again, I meet businessmen who will say that there's this kind of, to the ultimate degree, this free market system that has to be defended in all circumstances. And they kind of put that in their planning. At least I think many of them put that in their planning. And what they're not ready for is more government and government action. And I think we've seen that in the last 7 or 8 years. I mean, I think what is the biggest conundrum for the plans American companies have made in the last 7 years? Why haven't they invested? So every business cycle America's ever had, at some stage you get an investment cycle kicking in, and that's what really drives growth. And that's why this investment cycle for America has been really poor. And I think one of the really fascinating questions is why? Why this time have they not kicked off? And you can come up with lots of reasons, but I just think they don't understand the new world. They see things happening with the government and the central bankers. And it doesn't fit with the schema they have, and they're not prepared for it. So they need to re-educate themselves. They need a liberal arts education, and not a business education. And I do this quite a lot. I go around and I speak to businessmen and I say, who in this room has got a degree in politics? And nobody's got a degree in politics. but they've all got degrees from business school. I didn't go to business school, but I'm a lawyer. But I think there's only two things they teach you at business school: supply and demand. In the real world, financial history world, you get governments and stuff like that. So I can't be too precise on that. But I think they're ill prepared. They're still using a business school thinking. They need to get beyond that. They need to hire more people who know a little bit about politics and society and begin to adapt to something a bit different. Maybe something a bit more Indian, somewhere in the middle. Well, time will tell.
Thank you. Appreciate it.
Sir, do you think there is an inflation in equity valuations globally?
Well, it's a very good question. So I showed you the cyclically adjusted PE for America, and the answer to that question would be yes for America. Now the question is it global or is it just America? I think the easiest answer to that is, can we imagine the scenario where the American stock market collapses and everybody's okay? So there's always still now in the vestiges of American power an impact of when the stock market falls in America, and it would be bad for everybody else. But actually a lot of markets are not nowhere near as overvalued as America. European markets are close to their long-run averages. Some emerging markets are quite cheap. And all that would say to you is, if you want to take a 10-year view plus, you should be investing in emerging markets and not America. So in the short run, I'm afraid if the American stock market's coming down, I think just about all stock markets are coming down. In the very long run, the Cape is giving you different readings for different jurisdictions, and you would be looking more at emerging markets. India's Cape is always very high. I've got this sort of very optimistic view of India, but I've never invested in India, so I just keep looking at valuations, and I cannot bring myself to do it. So hopefully, even India, equities will get to a price where they seem pretty reasonable for the long run investor. So if you're taking equity valuations and what they tell us about the long run, emerging markets to beat Europe and everybody to beat the United States of America, which seems to be the exact reverse of what people are telling you, therefore it probably will.
You say like 6 years after the launch of QE, we get deflation anyway.
Yeah.
Don't you think we should change the inflation index and include equities into that?
Including what?
We should include equities into that.
I think it's a great point. I mean, I think putting asset, we need a CPI without asset prices. It affects so many people in so many ways. We have index-linked securities apart from anything else. Pensions are linked to this, and we need that. But I think you're absolutely right. We wanted to accurately measure inflation. We should have another measure of inflation, which includes asset prices. That might happen one day, but we do still need a CPI because so many wages and so many pensions are linked to the CPI.
Taking advantage of the low rates as well as ample liquidity, the government can spend on the infrastructure which is needed. It can create low-end jobs. It can spend even private capex. It's good for improving the productivity, which has been low for the last 20 years. Do you think that could be an answer to most of the problems that we have?
Well, I prefer a better answer, which is forgiving student debt, which is also a fiscal policy.
That would improve the productivity, which has been declining for the last 20 years.
Well,
Ultimately, you need better productivity for sustainable high growth.
Yeah, well, I mean, when you forgive student debt, you think the students just go and spend it on consumption, but they might do a lot more creative things as well, get out of some of the jobs they're in and do something better as well. And the difference between those two policies is that one of those policies, the government takes the money of the people and decides what to do with it, and the other of those policies, the government stops taking the money of the people decide what to do with it. So I ideologically prefer the first. And that's why, I mean, there are some economies, obviously, where you think there's insufficient demand, you need the government, but another genuine fiscal policy would be to relieve the tax burden on not old people, on young people, because the young people who will spend and the old people, if you leave the tax burden on everybody, the old people would probably save it. But if you leave it on young people, they'll probably spend it, but it just frees up more opportunities and more equality for young people if the debt burden was removed.
It may not necessarily have to be a government spending, it could be just fiscal incentives where you create the environment where corporations sitting on so much of cash invest, and the pension funds who are looking for an asset class you are advised to keep cash, feel incentivized to invest in it.
Well, now we're kind of agreeing. One thing is it would be better if the government didn't do the spending. And there are fiscal policies you can put in place so it's not the government doing the spending. I'm focusing on the young people because I think we need more demand, but obviously you can do it through the corporations as well. The problem today seems to be a lack of demand, so maybe young people first, corporations second, government third.
last thing, what can cause global meltdown in equities or equity meltdown in US markets? What 1 or 2 points can trigger the meltdown of equity?
Yeah, that's a good question, because I actually think if we are going to see a meltdown, it will be in Europe and not in the United States of America. Europe is facing some severe political problems in finally creating an operating euro. And I think we've come to the stage now where we can say that politically it's failed to create a euro, we'll begin to go backwards. So I don't see a collapse coming out of the United States of America. Its financial system is much sounder than Europe and other places. But if things start to go very wrong in Europe, which I think they will clearly have a negative impact on America. I actually think the yuan is going to fall. You might say, what on earth is that going to do with America? But we'll have this great belief that the world's heading towards deflation, and the American Central Bank can't do anything about it. So it may be that the problems begin outside of America, but they would inevitably have people asking the question, can the Fed actually solve these problems? I think the answer to that is no. And I suppose the other thing just to add to that is, where all these things meet is a very, very strong US dollar. And a very, very strong US dollar doesn't create a collapse for America, but it clearly creates some problems for America if the dollar keeps going up and up. If China's going to devalue, if Japanese are printing money, if the Europeans have issues with keeping the currency together, then a very strong dollar is not good for anybody. But I think it's what we're most likely to get. But the interesting thing about that is America's at the back of the queue. It's not at the front of the queue for that.
Last 2 questions.
So, do people realize the full consequences of Brexit?
Wow. So we've got another hour. Have we got one more hour left?
And if I can add to that, does it also mean a Scottish exit?
Okay. Good. So one of the ways you can try to look at the world is pretend you're sitting 20 years in the future and you're reading a history book. And what historians have to do is wait things. We don't. We're kind of living in the present. And this thing, because it's right in front of us, is the thing that dominates our vision. And obviously that is Brexit, and that's the thing that is distracting us. Sitting 20 years in the future, I would be surprised if it got more than a footnote in history. Because it depends what comes after it. And it's what I've just been talking about. There are things happening in Europe which are much, much more important than Brexit. The United Kingdom is not in the euro. It may be in the European Union, but it's not in the euro. Leaving the European Union is going to be painful for everybody. But leaving the euro would be horrific. So let me put it this way. If you were telling me that Finland had decided to leave the European Union, I think that is much, much more important than the United Kingdom. Now, Finland's a tiny little country, but it's inside what they call an insoluble currency union. So Brexit leaving has also triggered some other things. It particularly triggered a thing called the counter-revolution, which is led by Poland, Hungary, Slovakia, and the Czech Republic. And if I just tell you one little story about the Prime Minister of Hungary and the Prime Minister of Poland, it will show you the scale of challenges that Europe has in creating a union. And it's just 1 month ago they met at a conference, and they were getting on very well. And a journalist said to Viktor Orban, who's the Prime Minister of Hungary, "You seem to be getting on very well together." And Mr. Orban replied, "Yes, we're getting on well together because we have a saying in Hungary that you can be friends with anybody you can steal horses with." To which Mr. Kaczynski, the Prime Minister of Poland, says, "Yes, and the European Union is full of stables." Well, it's supposed to be a European Union, just with a small union. A union is where people cooperate. A union where people do things together. And now these 4 of them have got together to be the horse thieves of Europe. Europe's been under lots of strain and stresses over the last 7 or 8 years, but those have been financial and economic strains. They have not yet erupted into political strains. Now, there are other political strains. There's a woman in France called Marine Le Pen. We have a thing in Germany called the Alternative for Deutschland. We have a thing in Italy called the 5-Star Movement. And what do they have in common? They're not keen on the euro. There's a fascinating poll in Europe. They poll Europeans and they ask them 2 questions. Do you want to be in the European Union? The answer is usually yes. Second question is, do you believe power should return from Brussels to your sovereign parliament? The lowest reading anywhere in Europe is 66%, and it's in Germany. So people like the European Union on the whole, but they also want to see less power in Brussels. And these things are incompatible. At least having a euro is incompatible if you're genuinely going to return power to those countries. So Brexit, I think, is just a side. Is the kind of, it'll be the foothills. It's like if you head towards the Himalayas. You've got to come to a hill before you come to a mountain. So Brexit is the hill. The mountain is yet to come in terms of Europe. In terms of Scotland, which is where I live, I have a Scottish family. I'm not Scottish actually. I'm from Ireland, but obviously I live there and it's my home. Its position in the United Kingdom is more secure than ever because the Scots now have to vote for two things that they didn't have to vote for the last time. They would have to vote for a hard border, and they would have to vote for the end of the pound. If the vote is for Scotland to be independent, and the United Kingdom does genuinely leave the European Union, it is incredibly difficult to believe that the border between Scotland and England would remain open. And it is impossible, I would say impossible for Britain, for Scotland to remain in the pound. It could go for anything called a currency board system, but for technical reasons it's, I think, very, very difficult. So the Scottish people didn't vote the last time for independence. These two things, I think, are such huge things that it's very unlikely. It's not impossible, but it's very unlikely that the Scots would vote for independence. Anybody here is a bit older will know that there are two ways you can leave a club. You can vote to leave, or you can get thrown out. Now, they might get thrown out. I think the policy of the Prime Minister of Scotland, the First Minister of Scotland, is to try and get thrown out by annoying everybody else. And she might well succeed in that. So, but I think it's more unlikely, given what's happening in the world, than likely.
I have one question. In recent years in the US, the best performing investment strategy seems to be of beta funds, volatility funds, and passive funds. And the worst performers seem to be the hedge funds, and value funds. And these fund managers keep saying in press interviews that the problem is that the central bank is very interventionist in the market, basically by managing volatility, and which is negative for value investors because they don't permit extreme points on the lower and higher side, and by managing the volatility, which now the beta funds have got tuned to, so they know what the bank will do, so they kind of know the response function. Would you agree with that assessment of the fund managers, and how do you see things panning out going forward as the US begins to normalize monetary policy, or is it trying to?
Well, I certainly agree that that's what's been going on. It's really fascinating. Some of the world's best fund managers have retired. They've given up. They said the rules of this game have changed. I don't understand the rules of this game. I do try to cheer them up by quoting Hyman Minsky's instability hypothesis. The more stability you create, the more something's going to break out with massive instability on the other side of it. And that was kind of the lesson of the great financial crisis. Bernanke created this thing called the Great Moderation. Remember the Great Moderation? And that moderation created a stability which was supposed to create wonderful things. It didn't. It created incredibly dangerous things. So I think the apparent stability you create from this ultimately breaks out in massive volatility. If any of the things that I've just mentioned happen, China devalues the exchange rate, the euro begins to break up. We're not going to live in a stable world regardless of what central bankers do.
So you are amplifying the tail risks?
They're absolutely amplifying the tail-end risks. And most of my, you can probably tell from this presentation, most of my friends are value fund managers. They're pretty miserable people anyway. But they're certainly miserable today, given what's happened in the last 6 or 7 years. But we've been here before for value investing, and it's the only. I did say there's only one. I said there's only one way you can guarantee outperforming in the long run. It's called patience. Well, that's what value investing is. And 6 or 7 years is a long time to be in the wilderness. But I have no way whatsoever is the time to give up on value investing. Quite the reverse. Just on that index fund thing you mentioned as well. I think it is a really, really dangerous time to get an index fund. Because there's first of all, there's massive technological transformation of industry underway. And of course, some of the incumbents, the targets are in that index. Number two, you've had 3 decades of falling interest rates and falling inflation. So the stocks that are going to be biggest and dominate the index are going to be beneficiaries of falling inflation and falling interest rates. And we are just about sometime in the next few years to turn that around. And finally, there's still a lot of banks in there. And the first rule of all investment today should be never own a bank. For reasons I could go into in another one or lecture. But don't buy a passive fund, buy a value fund. But I don't have to tell anybody that here, given that many of you are here to study value.
One last question. Just as in an evolving economy like India, where you move from a protected economy to a free economy, and from a service-oriented economy to a manufacturing economy, where the P multiples for each industry is so different, and as the dominating industries change in an economy, how do you revert to mean, and where do you revert to mean?
Yeah, I think that's one of the most incredible things about this chart on the second industrial PA. Let's think how much America's industry transformed over this period. You know, I mentioned in 1901, it's all railroad stocks. It's not really railroad stocks anymore. And yet it's still being reversed. The PE is still within, see, I think that, you might think that's a very wide band. I think it's quite a tight band. This side of the equities have only been really between about just a little bit less than 10, and never very long above 25. And there's been massive structural transformation in that. It's gone to the services industry. It's kind of gone beyond services industry now to places like Facebook, and yet it's stayed in the band. So I think, what I said in that lecture was I think there's something in an economy in terms of the growth rate it can achieve at the discount rate which is sustainable, which limits the band. And I think it doesn't matter if you change the composition of the industries, and I would cite that chart as evidence that there's one place where it hasn't mattered. And I can think of no economy in the world that's transformed more over 100 years than this economy, and yet it just hasn't mattered.
Thank you.
Another one question.